Welcome, everyone. We're slowly filling up the room. As we do so, I want to let you know that this town hall is in webinar mode, and that means you can see and hear only the presenters. We do this to minimize distractions and any background noise so that we can all enjoy the best experience possible. Your questions are always welcome. So at any time during this webinar, we invite you to open the Q&A box, type your question in at the end. We'll answer as many as we can. If time runs out, we'll reach out afterwards. Of course, you can email us at any time with your questions. Today's town hall, you should know, is being recorded, and the recording and all accompanying slides will be up on our website probably as soon as tomorrow. And finally, a disclaimer that nothing that you see or hear in this town hall should be construed as offering any investment, legal, accounting, or tax advice. You should always consult your own advisor or the appropriate professional. So if we could go to the next slide, I want to welcome you again to this United Church Funds Town Hall for the third quarter of 2023. I'm Charles Buck, President and CEO of United Church Funds, or UCF. I hope all of you are staying well and warm as we move into these closing weeks of 2023. Since we can't see one another, and to get a sense of who's in the room today, we're going to start with a quick poll, and it should pop up on your screens shortly. The first question, why don't you go ahead and fill it out? The first question is how many of these town halls you've attended. Is it your first time, second or third time, or maybe more? And in the second question, we'd like to know about your organization. Tell us about your organization. If you're from a local church, are your total investable assets or your endowment less than $1 million or more than $1 million? So go ahead and click the box. It'll be up for maybe another 30 seconds or so. Don't think too hard about this. It's all just about knowing who's here. And all of these polls, by the way, are completely anonymous. So as soon as the timer runs down, we'll see the results, see who's here. And it looks like we have a lot of returnees. That's wonderful. And about 16%, 8 of us are here for the first time. And as we expected, most of you here are representing organizations. The organization, rather, you represent is a church or local church. And quite a few of you have investable assets over $1 million. No one from social health services or educational institutions, but we do have those as clients. So I want to welcome all of you. Thank you so much for being with us, and a very special welcome to all of you attending your first town hall. Our hope for you and our goal for you at these town halls is that you'll come away with a good sense of what's happening at UCF, in the global markets and the economy, and with your portfolio. As stewards and fiduciaries of your churches or organizations' assets, it's important to be up on what's happening so that you can make wise and informed decisions. And that can be quite a challenge these days, with continuing themes of volatility and unpredictability around interest rates and inflation, exacerbated by Washington politics and geopolitical conflicts, while also caring about an earth that's under strain from both human activity and negligence. So we can't promise that this town hall will make sense of how everything fits together, but we'll try to give you a good idea about how your investments have been affected by all of what's happening, and also how your investments are having an effect on what happens around the world and in the earth. If we could go to the agenda slide. Stacy Pettis, our executive for institutional relationships, will start us off introducing some new board and investment committee members, followed by Matthew Ilian, our director of responsible investing, sharing responsible investing updates. We'll do our second poll then, and then Matt Wagner, vice president of institutional relationships, and Stacy will take us through the market and fund updates, and they'll be joined by our investment team from the pension boards UCC, Dave Klassen, Lon Kai, and Minoti Dhanaraj. Just to remind you along the way, if you have questions, please put them in the Q&A. We'll take them at the end. And finally, I want to give a shout out to our marketing and communications team, Debbie Wibowo and Adam Sank, whom I thank profusely for their tireless work behind the scenes making these town halls possible. So again, thanks for being with us. And now we'll go to Stacy Pettis to bring the organizational updates.
Thank you, Charles, and thank you all for joining us. We wanted to introduce to you some new and familiar faces regarding our board and investment committee members. So starting on the top left corner, we have our board chair, Reverend Penny Lowe's. She has been a longstanding member of our board of directors, a retired educator and clergy person residing in Michigan. And we're grateful that she has stepped up to lead our board of directors in this next chapter. We also have over to the right our new general minister and president, Reverend Dr. Karen Georgia Thompson, who has an automatic seat on our board of directors as her position and title appoints her to be on our board. And also Julia Gahn, who is the chair of the UCC Board of Directors, also has a position within our board as well. We're also excited about a new investment committee member that's recently joined, Bill Lee, who's a highly accomplished chief investment officer, now retired and living in the Bay Area. We're super excited for his expertise and experience on our investment committee. He will not be joining the board, but will be a part of our investment committee. And we also have David Meismer joining us from the Twin Cities. He's an individual who's spent a lot of time in development and research within the IT development space, and we're grateful for how he has been in contribution to our boards thus far and will continue to add value there. So as you see some these names and faces pop up within our organization, please send them a warm welcome as well. If we could move on to the next slide, I wanted to just fill you in on some of the really great things that our staff has been participating in as it relates to conferences and events globally, not only domestically. Pictured is Charles, who just spoke, as well as Matthew Illian, our Director of Responsible Investing, at the Principle for Responsible Investing conference in Tokyo, Japan, that took place about a month and a half ago. They are also attending some conferences and events that are coming up, one of them being an event during ICCR Living Wage Week. And that takes place on November 7th. It is a virtual event. And if there are any interest in being a part of that conversation and hearing the great speakers that are involved in that, we are happy to provide a link for you all to join. There's also an event happening that the UCC is hosting related to greenwashing. And that is an opportunity for you also to participate virtually. And then there is also a conference that will be in mid-November around Responsible Investing Conference USA. And Matthew is happy to share a bit more about details about those events and those conferences that are upcoming, as he will also share some of the great things that are going on within the responsible investing space. Matthew, I will turn it over to you at this time.
Thank you, Stacy. And I see Debbie Wibelow, I think, just shared some links to some of these events. I will say on the Living Wage Week, on that webinar, we'll be talking about our work with the dollar stores and advocating for wage hikes for those retail employees. If anyone's interested in what a living wage is, there's a great calculator. It's called the MIT Living Wage Calculator. Don't look it up now, but maybe just write it down. If you want to see in your county what a living wage is and how that breaks down, by all of the expenses. It's a lot higher than you might expect, and a lot higher than minimum wages, especially in those states that still have the federal minimum wage of $7.25. The UCC event, this is really this is led by our Environmental Justice Minister, Brooks Byrne, and it's leading up to COP, or it's the committee, the UN Committee on Climate Change. And it's called From Greenwashing to Environmental Justice. And there's a lot of concern right now that this COP is being co-opted by the oil and gas industry to, not really be about climate justice, but kind of preserving a slow transition and preserving the status quo. So you might be interested in that. Again, you can click on the link and sign up. And then lastly, Charles and I will both be attending the conference Responsible Investor USA and in mid-November. And again, we'll be talking about advancing worker justice, which is a key engagement area for us. On the next slide is a nice montage of all of the areas of sustainable and responsible investing that we focus on, and in many ways we're led by the prophetic and faith vision of the United Church of Christ and the different ministries that have been born out of the church. One of the areas we wanted to talk about today, considering the tragic world events and the war in the Gaza Strip and Israel, and this is on the heels of what's going on in Russia and Ukraine, and we wanted to make it clear to those who are invested with UCF that we have a long-standing commitment to not profit from war. I went back and looked at when those commitments were made. In 1983, the UCC passed a resolution seeking to avoid investments in weapons. And then in 1985, there was a resolution on being a just peace church. So long-standing history there of the faith-based avoidance of profiting from weapons. We also screen out companies who have the worst human rights and labor rights records and controversies. And so you can see the weapons screens leads us to avoid about 170 companies. And then for human rights, another 40. And Debbie posted, if you want to look at all of the screens that are available, that we focus on, including tobacco, coal, and oil, tar sands, etc. You can click on that link. Beyond the screening part, most of what we're doing is engaging with corporations on when we're looking at this space of peaceful pursuits and justice. We have 3 engagements that we wanted to call out. One is with Analog Devices. They were identified in a research report for some of their components ending up in Russian weapons. And so we've started an engagement with some of we have human rights consultants, and engaging them on their Know Your Customer protocols and their enhanced due diligence. I know they were not pleased to see that their components were showing up in weapons, and we've provided a list of requests that we have for them to enhance their due diligence process, and we'll be able to share with you the results of that over the course of this year. Similarly, with NVIDIA, they have experienced a tremendous growth. They have chips that are their GPU chips are considered the fastest in the world, and they've been used by surveillance technologies, AI applications. They've also been in the weapons use, and so we're also in the same way engaging with them on their Know Your Customer and their due diligence process. On one hand, investors have profited tremendously from NVIDIA. They're considered one of the magnificent seven, in addition to several other technology companies that have just grown by like 50% in the last year, have a little fallback. But with that growth comes enhanced expectations from investors that their human rights due diligence process is growing with them. The last engagement we wanted to call out was with Hugo Boss, and they have been identified by researchers for having some of their cotton coming from the Uyghur region. There's now isotope testing that's going on to help these producers, these clothing fabric producers, know exactly where their cotton is coming from. And as many of you know, there's a long history of forced labor and internment camps in the Uyghur region in China. And Hugo Boss has said they've pulled out of that region, and they've done a mapping of their supply chain, and yet some of this isotope testing continues to show that there's product coming from that region. And so it's a complex supply system, as many of you know, and we're holding companies accountable to continue to do the hard work. We do want to celebrate also, when we see good accountability happening, and in this case, Dollar Tree received or agreed to a settlement with OSHA, and this is around their health and safety practices. For a long time, we have been with other investors and other civil society NGOs calling for more accountability on their health and safety practices. And this settlement is really an agreement that Dollar Tree is, understanding that they have work to do. And so this $1.35 million fine that they paid, in addition to ongoing fines for any future violations, is something that we are applauding, because we know this is really raising the issue at the C-suite level. And we're starting to see Dollar Tree really take this seriously, and the settlement is one acknowledgement of that. And so we are going to continue to engage with Dollar Tree. We have not seen the same kind of acknowledgement from Dollar General. And so many of you will remember that we helped co-file a shareholder resolution last year that received 67% support at Dollar General. And so we're expecting that their board of directors and their executives are going to be able to demonstrate that they're also taking this work seriously. On the next slide, we also want to talk about not just the how we're holding companies accountable, but also the positive investments or the impact investments that we are making through the funds, through your investments. One of the ways we can do that is through investing in development banks or multilateral development banks. Probably the most common one that you'll be familiar with is the World Bank. And you can see the second in that list. We invested $250,000 in a green bond, and this money is used to finance water purification in Vietnam, and we're excited to participate in that bond. Additionally, we invested $1.75 million in a peace building bond, and that's through the Japan International Cooperation Agency. And this is these green and social bonds are ways that we can put this money to investment to positive impact in the world, particularly in a time of war. To see investments in peace building is something that we're proud of and will continue to do. And with that, we have another poll question. So the question is, which geopolitical factor is most immediately concerning to you in terms of its potential impact on the financial markets? So this is my way of transitioning from the sustainable and responsible investing to how these geopolitical factors impact the markets. And we'll give you all a minute to put your answers in, and I'm going to hand the presentation over to my colleague, Matt Wagner, our Vice President of Institutional Relationships.
Thanks, Matthew. It's great to hear about all the good work that is happening behind the scenes at United Church Funds to make sure that our investment returns are in alignment with the values of our clients, and grateful as always for these updates. As we go through the geopolitical factors, of course, we're allowing you to a single choice here, and the reason we're doing this is to really, find out where our clients are have the most concern globally. There's a lot going on, and so we see here that about a quarter of the respondents, the war in Israel-Palestine, and the war in Ukraine, U.S.-China strategic composition, and then a third of the folks on the call have the most immediate concern around political instability in the U.S. Interestingly enough, no one chose the selection at the bottom, the Taylor Swift effect. We did put that in there in some way, sort of tongue-in-cheek. There's so many things going on across the globe, but we will note that a couple of studies are out related to, for those of you who might be Swifties on the call. We'll go ahead and share these results. Or know who Taylor Swift is. She is an incredibly successful and popular pop star. She is in the middle of a global tour called the Eras Tour, which, according to the U.S. Travel Association, is going to impact global economies with positive direct and indirect investments of around $10 billion. Amazing. Another very popular music star that has a current tour, the Renaissance World Tour by Beyonce, according to the New York Times, that tour by the end of it is going to register about $4.5 billion of economic impact. To give that a comparison, of $4.5 billion of economic impact would be comparable to the 2008 Olympics in Beijing. While there are a lot of things that certainly are on our mind that concern us, there are also some maybe unlikely and maybe not catching the headline news, but some of those things that we thought we would just bring to your attention as positives for the economy. Adam, if we could go to the next slide, we're going to dig into some market and economic data. And just a couple of bullet points here. Of course, the first half of the year, we saw a nice rally after a more challenging 2022 in global equities. But that rally, as for many of you that met with Stacy or I over the first half of the year, we noted that was a narrow rally. You mentioned, you heard Matthew mention a term called the Magnificent Seven stocks. 7 stocks of the S&P 500: Microsoft, Google or Alphabet, Facebook, which is Meta, Nvidia, Apple, Amazon, and Tesla generated the vast majority of the return across the first half of the year, over 50%, bringing the S&P 500 up about 17% over the first 6 months of the year. Of course, we saw that pull back slightly in the third quarter, and that narrow recovery held a little bit, but there were some headwinds related to rising rates. As we look at all the different things that are happening across the globe, of course, conflict and other economic factors, the economic recovery that we've seen post-COVID has been really uneven. And so we continue to watch carefully our investments overseas as well as in the U.S. And we have some slides that we're going to share about that just a bit later. Because of the rising interest rates that we've seen over the last couple of years, fixed income yields and fixed income have become much more attractive. And in fact, we actually added to fixed income earlier in 2023, moving some money from equity to fixed income due to these more attractive yields and opportunities to buy into back into fixed income, which of course has not been in favor over the vast majority of the last decade with low rates. As we go to the next slide, we'll point to some performance numbers. On the left, you'll see a variety of indexes and their quarterly, year-to-date, 3, 5, and 10-year performance. I'll just point out that year-to-date, Of course, the S&P 500, the Russell 1000 returning about 13% through the first 3 quarters of the year. International developed markets is represented by the MSCI Europe and Far East, or EFA index, returned about 7%. Small cap stocks in the US, as defined by the Russell 2000, returning only about 2%, and emerging market equity a little south of 2%. As you move further down the list, you'll see bond indexes, essentially mostly negative or slightly negative to maybe slightly positive, where we have a little bit more correlation with equities in emerging market debt and global high yield. And then on the right in the bottom, you'll see 10-year Treasury, 2-year Treasury, and 30-year Treasury. You'll see that the 10-year Treasury ended September 30 right at about 4.6%. As we noted, the rates were fairly flat for the first 6 months of the year, and we saw a 75 basis point increase in the 10-year Treasury in the third quarter, which represents essentially the entire annual increase in rates for the 10-year Treasury. In the 2-year Treasury, which sits at a little bit north of 5 as the end of the quarter, again, we saw rates moving up this year as well. So as we go to the next couple of slides, I'm going to bring in my colleague Lon Kai from our investment team. Lon and Menothi and Dave from the investment team are all with us, and we'll be hearing from them over the next few slides. We have a slide here that shows the valuation of the S&P 500 at various points in time, all the way back to 1996. And if we focus on the far right of this graph, you can see that we experienced a pullback in US and global equity markets in Q3 after a fairly robust, but as we discussed, narrow recovery in stocks in the first half of 2023. If we look back a bit further, though, if we just look at the last year from October 2022 to October 2023, we've seen that the S&P 500 has gained around 20% in value. And of course, our clients through our equity exposure have benefited and participated in that rebound. If we switch to the next slide, one of the key economic metrics that has improved for most citizens over the course of the last year has been reduced inflationary pressures in everything, as you can see there, from housing to energy to fuel to the grocery bill. So Lon, our opening question for you and the investment team, as we look ahead to macro risks and other potential global challenges in the coming months and years, in addition to inflationary pressures, as we can see here on this slide, which are both sticky and some of them are transitory, what might some of the other key metrics that we monitor look like? Lon?
Yeah, thank you, Matt. This is a good question. One key metric that we look very closely is the corporate earnings. And as you know, that we are in the midst of corporate earnings season right now. Apple just reported after the bell today, about 2/3 of the companies in S&P 500 reported so far. And we saw about little over 1% sales growth among the large cap companies. And then the earnings finally turned positive. So year over year earning is 3.3% growth. And that is quite different from 2022, where you have an earning recession, and subsequently we have 3 quarters of negative earning growth. So finally, earning is turning positive. We have something to look forward to. And there's a big dispersion among the earnings. Other factors, I think that your earlier poll reviewed something interesting. The element that ranked the highest of geopolitical is the political instability in the US, which is kind of a surprise to us. And that has implications. And I would think that the sum of it is due to the ever-growing deficits in the US, and that it has implication now towards the interest rates. And then next year is election year, so we have a lot to watch. And since you're on this inflation charts, inflation, we're not done watching inflation yet. Like the Fed, as you mentioned, that the headline inflation coming down largely was driven by energy price coming down, and also the new and used vehicle price coming down. And on the core side, it was driven by airfare came down, and also the medical service cost came down. But if there is any element of the stickiness in the inflation, Fed might still move. So there's a lot to watch. And on top of that, since we invest through managers, we always look at the managers to see if their performance matches their investment style in the market environment, and whether those managers are taking advantage of the dispersion in the corporate earnings among the geographic regions, big versus small, or growth versus value. And so that we always stay vigilant to add value for UCF investors.
Lon, thanks for that robust response. I think to summarize, we're starting to see some green shoots with earnings this year, particularly after last year, which was rough. But gosh, there's still a lot of things to worry about. I'm grateful that you were able to break all of those things down for our clients. I'm going to turn it back over to my colleague Stacy Pettis for the next couple of slides in question. Stacy.
Thank you, Matt. I'm going to actually loop in Minothi Dhanaraj from our investments team to answer the next question. So thank you, Minothi, for being here. One of the economic metrics we closely monitor is relative strength of the US dollar versus other currencies. Historically, a stronger dollar has a downward impact on international equity exposure. And as the next slide indicates, US markets have experienced significant outperformance relative to both international developed and emerging market performance. So with that said, the next slide gives us a really interesting data point that over the past nearly 30 years, the International Developed Market Index, which is the MSCI Europe and Far East, has outperformed the S&P 500 approximately 40% of the time. And the Emerging Market Index, the MSCI EM, has outperformed the S&P nearly 50% of the time. So given this data, can you discuss with our clients the benefits of global diversification in equities and how UCF's ability to tactically and strategically overweight both US equities as well as international equities can provide total return benefits over a longer period of time?
Great. Well, thank you, Stacy. I would love to answer that question. And I think this slide is very representative of the benefit of having a globally diversified portfolio, because as you can see, to be able to attain the best returns for the given amount of risk, you really have to have a globally diversified portfolio. So there are many factors that we consider in terms of our tactical asset allocation, and those include factors such as macro, style, and sector. As you noted on that slide 17 with the emerging market and the US dollar weakness, that tends to benefit emerging markets as well as in certain respects, international markets as well, and vice versa. If we see signs of shifts in the market, so the dollar has been strong thus far, but if we start to see weakness, we start to think about those tactical allocations to move towards more emerging markets and international markets. Geopolitical tensions, as Matt noted earlier, can also guide our decisions in terms of what's going to be most impacted and where we should allocate across different geographies. And then on slide 18, although it shows that the US has outperformed since 2009, if you look at the 9 years prior, you'll actually see that US large cap was the worst performing asset class. So just showing that shows that over the long term, a globally diversified portfolio tends to better position us to weather different environments and to provide more stable returns over time.
Great, thank you for that. That definitely gives us really good perspective as we're looking at some of the really great domestic outperformance and wondering, some clients may be wondering whether they should make a shift or not. But thank you for really breaking that down to why the diversification across domestic and international is essential in our portfolios. I'm going to turn it back over to Matt to go through the next couple of slides and ask another question of our investments team.
Great. Thanks, Minothi. Thanks, Stacy. I'm going to bring Dave Clausen in, Chief Investment Strategist. Dave, good to see you tonight. Thanks for your time and the time of the entire team as always. We're going to switch gears, talk a little bit about the bond market. Clearly, the bond market's been under pressure over the last couple of years with rising interest rates, and we saw that start to wane over the first half of 2023. We got a little bit of a reprieve with fairly flat rates, although, as we mentioned before, rates have started to sort of march up again in Q3. If we note the chart on the right, this is typically a chart that we've shown in portfolio reviews, which shows sort of the upside and downside probabilities of a 1% fall or rise in interest rates related to various types of bonds. And what this chart tells us now is that essentially most of the downside risk appears to be muted or priced in. In fact, outside of long treasuries and a couple other places, regardless of whether whether rates go up or down from here, it looks like flat to, potentially positive, very positive performance if we get a rate decrease. When we switch gears to the next slide, we're going to talk a little bit about a 60-40 portfolio. So of course, most of our clients at United Church Funds have a version of this 60-40 portfolio, whether it be in the UCF Balanced Fund, the UCF Beyond Fossil Fuels Balanced Fund, that might be all of their portfolio or at least a portion of their portfolio. And of course, the idea that now we can position portfolios differently related to risk in the bond market can impact our views on this sort of traditional 60-40 model. Interesting article in the Wall Street Journal, was it last week or a few weeks ago, that was sort of talking about the demise of the 60-40. We've also talked here about the comeback of a 60-40 after 2022 saw essentially the third worst performance out of the last 50 years for a 60-40 portfolio. So Dave, my question to you, of course, with as many clients as we have at UCF using that balanced fund or the Beyond Fossil Fuels balanced fund in that 60-40 mix, can you help walk our clients through the flexibility that we have in overweighting and underweighting equity and fixed income in that portfolio, and where we might see us position those portfolios in the months to come?
Sure, sure thing. A nice setup for my predecessors in answering a bunch of complex questions and letting people know what we're looking at. I think the way in which the UCF, United Church Funds, is set up in terms of governance allows for a fair amount of flexibility. As Matt alluded to, the last 15 years have been relatively unattractive for fixed income. We've done our best to underweight fixed income to mitigate the downside and be overweight equities. And as you indicated, the starting point or the carry in terms of yields leads to an asymmetrical upside or downside because you've got that carry over the years. So to be really sort of tangible, we've used cash in the past. We have the ability to hold up to 10% cash in balanced funds. If we have a 60% target for equities, we are under the guidance of the investment committee permitted to overweight equities by 10% or underweight equities by 10% relative to that 60 target. Now, we seldom utilize the full weight of that overweight or underweight. But to give you a very tactical and tangible example, we have been underweighted to fixed income over the last couple of years. There was a great question in the chat in terms of the duration, but our exposure to fixed income has been lower than that 40 target consistently. In July of this year, really almost at the peak of the market, in consultation with our staff and investment consultant and the experts that we look to, we did reduce equities, somewhat, and add back into the fixed income market for the first time in years. And I think really the question is, for us is, what is the peak, and when can we maybe get up to that target weight of 60-40, rendering the 60-40 portfolio more attractive than it has been in years. The benefits of the 60-40 portfolio really are the diversification benefits, right? Really, when stocks go down, the bond should go up. And that was certainly, as you alluded to, Matt, wasn't the case in 2022. But we think the bond portion of the of the balanced portfolio is back. It may be a matter of timing. We've been allocating back into fixed income and balanced funds.
Thanks for that, David. A little bit of a follow-up question. Before I ask that follow-up question, I want to remind everyone on the call that we encourage your questions. There's a Q&A box at the bottom of the screen. If you want to put your questions in there, we'll be happy to respond to those. So don't be bashful. No such thing as a bad question. We love to have your input in these town halls. So if you've got a question, make sure you put it in there, and we will do our best to get to it. Dave, my follow-up question to you is related to cash. Stacy and I have been, which of course, cash over the last, call it 10, 15 years, essentially paying us zero, right? Hasn't been an asset class that's been overly exciting. We do have our cash and equivalents fund. And over the past, let's call it year, we have had a number of clients that have had real concerns over the geopolitical risks that are going on. And they've been looking to, find ways to maybe protect principal in a way that we haven't over the maybe say most of the last decade or more. The cash and equivalents fund right now is what we refer to as a stable value fund, and it's paying in the neighborhood of 5%. Where do you see cash for, maybe for a client that is maybe a little bit concerned about what's happening in the market? Can you talk a little bit about both, the potential benefits of going to cash in the short term because of the stability, but then maybe on the flip side of that, when markets start to go back up, the difficulty in timing that? You've been doing this for a long time, and timing the market is always a challenge for anyone. So I don't know if you can speak to that at all, or just at least in generalities, talk about, it might feel good to go to cash today, certainly for the safety of it, but then, what happens when markets start to go back up and the difficulties around decisions there?
Always a really brilliant question. And because cash is no longer quote unquote trash and yielding 5%, it is a safe place. And, speaking more broadly, it's healthy for individuals and also institutions to have that option. I think for our purposes, if you kind of look into the worries for next year, if we do go into an economic slowdown, and monetary policy has a long and variable, lag, and if the higher interest rate levels start to cause more of a recession, cash will be less attractive because the short end of yields will start to come down, and fixed income will be more attractive because if yields come down and you own a little bit of interest rate exposure in terms of duration, as we do in our fixed income portion, you'll benefit. But it's not, if Stacy's asked this question a lot, and I've answered this question a lot over the years. But if your immediate cash needs are a year or less, that's the portion of money that you probably should have in cash.
Thanks for that, Dave. Appreciate it. We've, the benefit of the balance funds and the flexibility that you described is that we can use cash within the balance fund. So our clients are able to sort of trust us in understanding what, and of course the UCF Balance Fund and Beyond Fossil Fuels Balance Fund with daily liquidity means that you can trust us to do the allocation piece without having to decide on your own how much in cash you need, or where you're going to sort of protect the portfolio. At the same time, you can still have access to that. So really,
and Matt, just a note, and you can trust us to do it. I think Stacy alluded to the composition of the investment committee. We have metrics, and we are judged by the ways in which we're allocating assets that are different from the benchmark, than the 60/40 benchmark. So there's an accountability and a scrutiny that comes with the trust.
Terrific. Thanks, Dave, for that. Appreciate it. If we move to the end of the presentation, we'll go to Q&A here. Sorry, do we have one more poll question? We do. Let's go ahead and pop that poll question up. This is before, when we will get to Q&A, I promise. Which topics would you like to hear more about in our quarterly town hall meetings? So again, this is a single choice question. UCF organizational updates, responsible investing updates and engagements, market performance and analysis. Would you like to hear from some guest speakers? We can bring in investment managers, other stakeholders and partners, other leaders. Maybe you feel that the amount of content is just right for each topic, we've hit the sweet spot. Or other topics which you can certainly specify in the chat box or send us by email. Always grateful to get your input on these town halls so that we can make these great uses of your time. Looks like we have about 60% of the folks who have participated. Oh, here come a few more. And looks like more market performance and analysis, but also more across the board as it relates to responsible investing updates, guest speakers, and organizational updates. So grateful for that. We take this to heart. We look at these poll results, and we'll build our future town halls related to these results. So really grateful for that. Thank you for the time. At this point, we're going to open it up to the Q&A. I see a number of questions here. A couple have been answered. Carl Lehman had a question about the duration of the debt portion of the balanced fund compared to the end of 2022. Carl, Dave Clausen reached out to you in the Q&A and answered this, but for the benefit of everyone, if you don't have that open, our duration of our fixed income fund towards the end of 2022 was around the mid 5.5 or so. Now our duration is a little bit north of that, in the neighborhood of 6. I just looked at our fund fact sheet as of the end of the second quarter. Fund fact sheets for the end of the third quarter should be out shortly. We were at about 6.5 or so at the end of the second quarter. That's pulled back now to around 6. So Dave, thanks for that. Steve Schneider had a question related to the current stock versus or global equity versus fixed income percentage in the balanced fund. Lon was kind enough to answer that question. Lon's response: as of yesterday's close, equity was at about 63%, fixed income at about 36%, and we were holding about a 1% cash position. And Mo Wright had a question about the 60-40 portfolio slide that we just showed, which was, he asked, does a 60-40 portfolio slide reflect a true 60-40, or does it include the cash adjustment that you discussed for UCF? It's a true 60-40. That does not include that sort of cash option or cash flexibility that we have within our portfolio in our sort of bandwidth, if you will, that we can operate within. A couple other questions here. How Stephen Hotchkiss asks a question: how are bonds rated? We use the rating services that are available to everyone: S&P, Moody's, Fitch, etc. As of 6/30, the fixed income fund at UCF had a average credit quality of AA. So hopefully, Steve, if you have a follow-up to that, I'm happy to respond to that. Bing Heckman has a question. Lon, I'm actually going to bring you in for a live answer. It looks like you're typing as we go. Bing Heckman, out in the Bay Area in Palo Alto. Good to see you, Bing. Why have bond values fallen when normally uncertainty, as exists with the 2 major conflict zones, et cetera, the challenges politically, leads investors to flock to safety as offered by treasuries? So, Lon, do you want to speak to why we've seen a little bit of a pullback in the bond market at the same time that we've seen a little bit of this political and global instability?
Yes, I think the question is in the the answer is part of it in the question, the instability. So Ben, you're right that usually it's a flight to quality when in the time of stress, and then the quality is U.S. Treasuries. But with Treasuries kind of a significant supply, given the growing deficits, the demand, and then not knowing if the Fed is done with hiking or not, which means that if the rates will go up further or not. So there is a bit of pause in terms of buying. So there's a bit of imbalance of supply demand. At the same time, there is kind of the geopolitical uncertainty. So it is somewhat different from the flight to quality that we used to, but it's kind of the reality at this moment.
Thanks, Lon. Appreciate that. Last question here that we have. I'm going to go ahead and answer this one live, and then I think we will wrap it up. Ronald Kepke has a question. What percentage of the funds in the U.S. Or what percentage of our total equity fund, which is the equity component of the balanced fund, is in U.S. versus global stocks? Since so many global companies are global in nature. Great point. Absolutely. Companies that are based here in the U.S., of course, doing business overseas. Companies based in Europe, of course, doing business here. But when we look at where companies are actually headquartered or domiciled, we find that about 60% of our exposure in the total equity fund, which again, the equity portion of the balance funds, about 60% in the U.S., with the remainder of that in developed international and a smaller sleeve in emerging markets. Great question. And with that, I want to thank all of the folks that have been on this call over the last hour or so. We're really grateful that you participated. I want to thank all of my colleagues for being such instrumental parts, not only of this call, but of our organization, and most importantly, of our mission at United Church Funds. Our mission is to develop investment allocation strategies for nonprofit clients that provide competitive returns, and at the same time do so in a way that's in alignment with your values. We are incredibly grateful for the opportunity to be a trusted partner to your organization. And of course, if you know of other organizations out around your area that you think would benefit from our approach to investment management and our approach to client service, we'd be grateful for the opportunity to speak with them as well. Again, thank you all so much for your time. Have a great evening, and thanks again for the opportunity to be of service to you. Take care.